As most of you know, I'm a contrarian trader. That means that when everybody else is bearish and can only see more and more losses piling up, that's usually when I'm looking to buy. But on the flip side of the coin, when everyone starts to get extremely bullish and they think that the sky's the limit and there's um, no possibility of price turning back down, that's usually when I want to sell. um, I've been watching this consolidation box here for 2.5 months, and uh, and one of my rules is that when price breaks out of a consolidation, when it does it late in a cycle, whether it be daily or intermediate, I usually that's a sign for caution, not a sign to throw caution to the winds. Um, and that's kind of where we're at right now with gold. I wanted to see this test. We finally gotten a full test of 1800, but it's coming on week 15. I really wanted to see this test of 1800 much earlier in the intermediate cycle, maybe around week 7, 8, or even week 10. If it could have tested that at that point, then I think it would have had a good shot of a sustained breakout. Now I'm a bit leery. So this is the time usually when emotional retail type traders want to swing for the fences. They can only see clear skies ahead, and realistically, this is when you just need to be trying to get a base hit. This is not the time to be heavily leveraged. There is a possibility that gold could break out above 1800 and run up to 1900. Um, that that is a possibility, but I think you have to play it with an unleveraged trade, and then you also have to have a stop. I would say anything back below 1775 would be a signal of a false breakout. Definitely 1750. The bullion banks defended that 1750 level for about 2 months until it finally broke out here. So if gold were to pop above 1800 tomorrow and maybe the next day, but then reverse, and if it moves back below 1750, that's a signal, a strong signal that this is a false breakout and you need to get out of your positions and get out of the way. Um, at 16 weeks, you're kind of starting to play musical chairs, and you may get caught at the top, and if you're heavily leveraged, you could take a big loss. Um, Generally speaking, you're better off to be trying to buy when the weekly charts are oversold, like they were down here or down here, or even here. At least that pullback during the market crash, at least that pushed the weekly stochastics back below 50. That's definitely better than going all in on an extremely overbought market. And that's where we're at now. We're getting very late in the intermediate cycle. It's risky. We're pushing up against a major resistance zone. So let me widen the chart. All right. So here's the long-term chart, and you can see we've got this triple top right here, major resistance, and we're just now testing it. The bullion banks, managed to block it here, and they blocked it here. So we haven't actually had a full test of this resistance zone until now. And like I said, it's coming at 15 weeks into this intermediate cycle. So I'm going to be leery about any kind of a breakout above this at this point. And like I said, I'm going to have a close stop, um, maybe even as tight as 1790, definitely at 1775. Absolutely, anything below 1750 is your signal to that it would be, it's a false breakout and you got to get out of the way. Um, so I'm prepared to. I'm going to give a breakout the benefit of a doubt. So if gold can get to, let's say, 1805 or 1810, I'll give it the benefit of the doubt and I'll take a trade, but it's going to be an unleveraged trade, and it's not going to be 100% of my portfolio by any means. Um, the trade to go all in and heavy with leverage is at the bottom of the next intermediate cycle low, not right now, in the hopes that a breakout is going to send gold to 1900, which it may, but gold is not going to get through 1900 on the first try, and there is going to be an intermediate decline here soon, and like I said, it should push this weekly stochastics probably back down to oversold here, and then that's the point where you want to do, put your foot on the gas and use some leverage. That's the point to do that, not right now with the market extremely overbought. And then looking at the bullish percent chart, and this is an oscillator, not a sentiment gauge, but intermediate sentiment is also getting um, starting to get a bit excessively bullish on gold as well. But this is just an overbought oscillator, and you can see there's only been one other time in the last 10 years or so that gold, the mining stocks have been this overbought, and that was at the top of the baby bull. So just kind of another warning sign. It is possible that the market can stay overbought for a period of time, but this is just another warning sign that you don't want to try and swing for a home run here. You want to just try and get a base hit, and then when we get that next intermediate cycle low, that's when you start swinging for home runs, but not at 15 or 16 weeks into the intermediate cycle.